All right, guys. I thought we would talk about investment appraisal and focus on discounted cash flow techniques. Now, one of the objectives of the syllabus is to explain the concept of time value of money. Now, time value of money, as I'm sure you are aware, basically says money now is always greater than money earned in the future, whether it's a future by a day or a week or a month or whatever. Money now always greater than money earned in the future. Basically, a dollar that you get today will always be worth more than a dollar that you get in the future, even though in nominal terms the money is the same. Now, there are three reasons why this is the case. The first reason relates to opportunity costs, which is basically alluding to the fact that by investing your money in a project or in buying an asset or committing it anywhere, you have actually lost out on an opportunity to earn an interest elsewhere. We'll talk about that in a moment. The next reason why money has time value is because of inflation. And the last reason has to do with risk. Now let's start and talk about opportunity cost. Opportunity cost really relates, definitionally, this is actually what you would have derived had you committed your funds or invested your funds in the next best alternative. You could imagine the next best alternative could be, for example, rather than investing in your project, let's say you had invested in the treasury bills where you were earning, let's say, 9% per annum. Now, if your project is giving you a return of, 10%, by actually committing to your projects, you have lost out on the 9% because it's the next best alternative after your project, which gives 10%. So basically, 9% is a cost to you. You must actually mark the word. This is an opportunity cost. Is the cost that you have incurred by committing your money elsewhere. Now, let's give an example. The point here is that with money, time really matters. Let's give an example. Let's say you invest $500 in your investment club, and you expect to get $550 back. Now, this could be in 7 days, or it could be in 1 year, or in 3 years. Now, to demonstrate the point that time counts where money is concerned, let's have a look at what these 3 time periods would imply in terms of rate of return to you. The formula for the return is basically the future value divided by the present value. Now we annualize the return. This is a return, annualized return that we're saying over a 7-day period. If you earn the $50 that you invested, you invested $500, which is the present value, and then you get back $550 over a 7-day period. What kind of return is that? That's the formula, and the formula yields, in this case of a 7-day, a 135% return. That's a massive 135% return. Over 1 year, the very same amounts involved, 550 divided by 500, that's 1.1. You then get a 10% return. Over 3 years, the same figures, 550 future value, having invested 500, it becomes a very small return of 3.2%. So we're talking about 135% here over a 7-day period. The $50 becomes $50 return, a 135% return in a 7-day period. But the same $50 in a 1-year period becomes a 10% return. But the same $50 absolute amount becomes a paltry 3.2% over 3 years. So you see, time matters where money is concerned. That's basically showing you therefore that the longer you commit your money, let's say over the 3-year period vis-a-vis the 7-day period, you're really foregoing a lot of return, because now you're going to get only 3.2%, even though the amount in absolute value is still 50. But had you then done the same over a 7-day period, you'd have gotten 135%. So time is of the essence. Time is of the essence. The opportunity cost of tying your money longer gets higher as time goes on than if you do it over a short period of time. Now let's talk about the next reason why money has time value: inflation. We know that there's a decrease in purchasing power due to inflation. I don't think this one needs a lot of explaining. It's a pretty much obvious issue that when you go to the shop with your normally you would spend $50 to buy goods at the store per month for your monthly grocery. Because of a 10% inflation, next year you'll be needing $55 to buy the same amount of money. So therefore, if you were to basically invest $50, you would want your money to, at the very least, after a year, to be worth 55 in order for you to still be able to buy the same basket of goods that you used to buy last year at 50. Now, the third reason why money has time value relates to risk. Now, risk here talks about uncertainty, and liquidity is a very apt way of actually understanding this concept of risk. The more liquid or the more liquidity you can get from your investment, that is, the easier it is to convert into cash. And obviously, the shorter the time you have invested, the quicker you will realize liquidity. So short investments have high liquidity. That is, a 2-year investment where your money is tied for 2 years will be less risky than an investment where you have tied your money for 10 years. The 10-year investment relative to the 2-year investment could be regarded as an illiquid investment and therefore the riskier investment. So there you have it. That's the time value of money. Thank you.